The IMF already warned that the more than a third of the global economy will contract, and there is a 25% chance of global GDP growing by less than 2% in 2023. But do you know what does it mean? It defines by the guidance that's a global recession. The recession that recently we gone through just 4 times after World War II. So it looks like there is a very hard time ahead. Luckily, you are in a good hands as it's Blockrevision, and we are updating you about the elements of economy, about the trading, investing, and helping you choose the best decision in order to protect your capital. So let's get into another episode of the series. All right, so as always, we are starting up with an economy view. What we have right here. Global recession seems imminent. That's why we starting with that slide. So US, EU, and China are slowing simultaneously. Purchasing Manager Index showed numbers that been negative in terms of its points. So when we are lower than 50 points, that usually means we are contracting the economy. Otherwise, seems expansion. So on Monday, we've seen data across Europe, Turkey, and South Korea. All of them are contracting. Data published on Tuesday, also from this time Malaysia, Taiwan, Vietnam, and the UK, showing that we have to worry as well. So, as you can find here, global economy in 2023 is prognosed to contract, as with some of the countries, as the US, if the resilience of the labor market will be maintained, will go through this recession with a kind of a most mild mode, but there is still many question marks. Won't the recession in the neighboring countries and the one from the Europes and Asia won't drag US economy down as well? So Kristalina Georgieva warned that this year, 2023, might be even worse than the 2022 was. So we are still waiting for what will happen in China. Recently, we also have seen a purchasing manager index dropping in the world factory. That's how the China is called among economists. So the question is, what will be the reverberations on the stock market of such phenomenon? So I am rather expecting that stock market won't get totally afraid, as there were just the guidance that been foretold already since October. So right here we have just a higher reassurance in terms of the newer data being published and new readings being put out. So the global recession is something that the public already finds as the most probable outcome. But the market was playing for that scenario in the first and second half of previous year. So it means that I don't expect any type of major sell-off on the markets, but it's yet to get yet to find out. So global recession in terms of economy is very difficult for all of the investors around the globe that are looking for opportunities in companies, also for retailers that are trying to make their ends meet everywhere in the world. But in terms of traders and investors, I don't find that will be bothersome. Yes, so this profits may get diminished. Returns of the companies may eventually languish. But in terms of trading, investing, it's all about the bigger picture and what everybody knows. It literally not matters, not matter the thing. So that's why I'm just putting you in a kind of a awareness that it's not an end of the world. More and more people will be screaming that we are right now in the recession, so better barricade yourself at home and don't stick out, as you will find an apocalypse around. But it is true. Typically, recessions are the best times for making purchases if you have capital for it. That's why roll up your sleeves and get ready for this year. Home buyers underwater. So we've told that the US may avoid recession, but I would say many will depend on the housing market. So we've been discussing the housing market as being a lagging indicator of a regional headwinds. About 270,000 home buyers who bought the house during the red hot housing market 2021 already owe more than their house is worth. That's what the Black Knight analysis found. So Federal Housing Administration FHA loan that many of those market participants took is a home mortgage that is insured by the government and issued by a bank or the lender that's approved by the agency, and that's are the mortgages, the type of mortgages that most of the buyers has decided for. And we can find over here that 25% of folks with FHA loans falling underwater. Additionally, some 80% had less than a 10% equity stake in their homes. So it's very terrible outcome. It means that right after, when those mortgage rates has risen, they won't have much to cover the expenses and recoup their debt. So it will be very hard to get out of this market on a barefoot, untouched by the crisis. That's why I would really expect not only correction, but maybe even a serious downturn in terms of home prices. For this one, you may expect somewhat slide on a home, or maybe I will guide you through this one. Let me find it out. So I will get you in a second to an index that shows very explicitly where we are right now. So XHB, that's the one I meant. So it's a home builders ETF, and this one is showing a downward tendency. Very important is how we will eventually end up the January as the month might be deciding for the market. However, I would expect the downward slide in order to get on par with this recent highs of January 2020. That's the most expected outcome. So that was the SPDR, and that's why you need to get very cautious. US mortgage rates up after 6 weeks of declines. So we are right now at the very high percentage point, the one that been seen recently in 2008. But the rise right back then was more gradual. So that's why economy may have prepared for that percentage point to turn up. This time, however, this skyrocketed tendency shown that we are right now very surprised by the economy economy headwinds, and that's why many of market participants do not even know how to sort out that elements that will get her out of this difficult situation. So I would say that most of the folks at risk of having their loans slip underwater were those who purchased when home prices were at their highest. So this Black Knight found at least 10% of June purchase originations when home prices peaked at $438 were underwater, with more than 30% having less than 10% equity. So it's really off the mark. So we are also talking about the headwinds in the Chinese economy. Recently, we've seen that China is about to reopen, and that caused a serious threat of bottlenecks in the economy. When reopened, China would have some problems with tackling with increased demand. Right now, however, this reopen is put into question, where we have that many cases that it caused literally an avalanche for the government, that many cases of COVID. So China's stock investors right now are somewhere in the this I would say deadlock, when they are betting for reopen on the one side, but are somewhere in the on the brink of the possible next return of lockdowns. For now, however, more investors are betting for better year than previous, where we have suffered from $3.9 trillion dollar route. So it was really, really outstanding. So this year, I would say, will remain under the question of tensions with the US, a key source of market volatility. So that's the one thing that we'll probably watch very carefully this year. So these bilateral ties have shown signs of improvement in recent months, but still there's many answers yet to deliver to the public. So these issues will still remain around the semiconductors sector, where um, many elements are unsolved yet. Also, one thing that is dreadful for investors is this weak housing market. That's a cause of a concern. Although a slew of rescue measures have stabilized investor mood, analysts have warned that a full recovery will possibly take months. And that's because, in addition to depressed home demand, many developers remain shackled by a heavy debt pile. So that was about China. We are right now in a tough situation also in the world's factory market outlook. So we have questioned the performance, the positive performance of Europe in terms of economy, but what the stocks say. So if we just switch over to charts once again, we may find right here that Germany 40, let's have a look at this one, is right now uh, winding up and trying to get through this overhead supply. For this one, if we just manage to get it over, another stop will be just 14.86. So it looks like after this rally, we are trying to build up another leg higher. Germany 40 is the one that right now not giving any signs of sickness, and it looks like this weakness being found out in September and a little of October. Right now is being extinguished by enormous power of bulls. So it means that as the market is leading the economy by 6 to 9 months, it means that right now, if we are looking for headwinds in the German economy, it already been discounted by that pressure downward. So it means that the market is right now expecting that within uh, first half, within second quarter, up to third quarter, Europe's condition, especially here in Germany's condition, will improve. That's the beauty of the markets when we can forecast the unforecasted, I would say. UK 100 also is getting out of this recent boundary, and we have the appetite for going higher as long as the France that right now is rebounding out of this downward line and trying to find France is trying to find another highs that may negate this very the very negative tendency of this pattern of head and shoulders that may be eventually reverted to the upside by the future positive performance. So that's given the chances that a recession in Europe may not be that that difficult to tackle, as we are already expecting further rebounds on the markets. So that's about the trading market outlook. Right now, let's get back once again to market outlook and especially to what 2022 has delivered. So we've gone through the carnage of mega cap, and that has coincided with Tesla underperformance, Meta underperformance, Tesla that delivered fewer vehicles than analysts expected, and also Meta that has bet on this metaverse that has cost the company billions and isn't expected to turn a profit anytime soon. So investors have been literally shaken out of the profits euphoria, and everything happened in the blink of an eye. So the good element is that, however, that we will soon put the year in the um, we put the year in the one of the worst years in the history of the stock market, when those qualification will be made. But we are already putting this year in the rear view mirror, and hopefully the next year will be much better. On the other hand, however, the bad news is that 2023 could be even more bumpy road, uh, at least for first few months. So weaker economic trends will likely form heading uh, into 2023 as the Fed battles inflation. So hopefully the milder inflation will help out stocks up for a better second half of the year. So what about the crypto? Crypto recently also had some problems. The fallout of FTX is getting messier. Crypto bubble has taken its toll. Crypto bubble burst, taken its toll recently, but the problems are not sorted out yet thoroughly. So after this collapse of Sam Bankman-Fried's company, we've right now finding that there is a verbal battle between Winklevoss brothers and the giant in a crypto world, Mr. Silbert, that's a head of digital currency group. So as early as June this year, Gemini Earn, that was a program that help investors to earn profits, was suffering the effects of the crypto bear market. Gemini became one of the several digital exchanges who had to lay off staff. In fact, the firm cut 10% of its workforce in June, or otherwise, it was around 100 employees. 7 weeks later, further 7% of staff were told they would be let go. Back in November, however, Gemini froze redemptions on its loan platform after experiencing liquidity issues when Genesis Trading also paused withdrawals. So everything revolves around liquidity problems. Right now, Winklevoss claims the $1.76 billion borrowed by DCG from Genesis was used to fuel greedy share buybacks, illiquid venture investments, and kamikaze risky NAV trades. So, as he said, everything has been run at the expense of creditors and all of their own personal gain. So, does it mean that DCG has been really tied to FTX problems to that extent that it may have very serious headwinds in the next turn? Mr. Silbert, in a tweeted response, refuted several accusations in a Winklevoss letter, saying DCG didn't borrow 1.6 billion from Genesis and never missed an interest payment to Genesis and its current all loans outstanding without providing more detail. So we had Gemini that has had problems but also we can find that at the tango of elements that are related to FTX collapse are even bigger. So right now we don't have any details that may provide the stance of Mr. Silbert. We still have the answers yet to get delivered. That's why I recommend you to subscribe the channel of Blockrevision, to get updated. But the bottom line is that when shit hits the fan, there's no one to clean off the walls. And that's why we still have that many elements to get sorted out that it may take even longer. So that was the elements of market outlook and crypto outlook. And right now we are heading into a exactly economic calendar for this week, and we are waiting for elements of ISM manufacturing PMI that will be delivered today at 10 a.m. from US FOMC minutes. We have also today at 2 p.m. and right after right after we have a balance of trade of US and inflation rate of European Union following non-farm payrolls from US. Today we had inflation rate of Germany, and it's lower, favoring growth on Germans the 40. So 8.6 is the one of the percentage that giving the chance of euro area inflation to peak. So it's very optimistic, and yes, right after we are jumping to trade idea. So in order for this, I need you to find out one of my proposition that is D40 that's already delivered. So D40 is the one of the German index that recently also, as we can find on the here on the slide, has been heavily shorted. So we can find it by CMC markets, 59% have sold DAX on today's rise, and position value was 70% to the downside. So after such a good, better than forecasted data, I would expect that all of these shorts will be destroyed. So for this one, let's have a look once again at the index. Right now we can find that we are trying to build up the power before another breakthrough, and the another stop is 14.64, and right after we have, as I claimed, 14.82. So on a 1 hour chart, we are right now finding that we have rebounded firmly from the previous support, and right now heading relentlessly towards 14.66. So for those of you that would like to take the chance of a participation in DAX rise, we can find it in terms of 15-minute charts. For those that are awaiting, this level of 14.18 will be the great opportunity to take a long position. So if I'd like to mark it up, uh, as I just said, there will be price action that should start right from previous resistance being set at 14.19. So in terms of this trading board, we have a risk reward ratio at 4.83 with a possible extension of a move even up to 6.72. So Germany 40 is the one of the indexes that's right now showing an enormous strength, um, even with such counterintuitive forecast of IMF. So on 1 hour chart, the German 40 is accelerating right now, but I would expect this one to get once again to around 14.19. If you don't want to wait for pullback that far, just await what will be the reaction of the chart to the previous highs of 14.28. If it get through without any barriers, you may long it even from here. So I would expect the area of entrance to get being attached to 14.18 and 14.30, and adjust your risk management accordingly to your entrance and to your capital. So in terms of today's episode, that's everything. If you have any question, just put it in the comment section below. And as a reminder, we are live, and if you like to post any questions regarding the economy or the trading or investing, I'm here for you to help. So in today's episode, thanks. Just drop a like if you had enjoyed, and see you tomorrow at 8:45 a.m. East time.